Good evening to everybody. I'm Matteo Manera, I'm Professor of Econometrics at the University of Milano Bicocca and Director of the Research Program on Econometrics of Energy Transition at the Fondazione Enrico Mattei. I'm very pleased today to introduce Javier Ollea Ferreiro, who is going to present a very interesting paper, a stimulating paper on the impact of climate transition risk on financial stability, a systemic risk approach. Javier is from the Joint Research Center of the European Commission. We have decided to organize the presentation this way, 40 minutes for presenting your paper, Javier, and then 5-10 minutes for a general discussion. Please be aware that if you have questions for Javier, you cannot directly address the questions to Javier. You have to write the questions in the chat. I will then read your question loud and Javier will reply to your queries. Okay, Javier, the floor is yours.
Thank you very much, Professor Matera, for this opportunity to present this joint paper done with Juan Carlos Reboredo from University of Santiago de Compostela and Andrea Ugolini from University of Milano Bicocca. Obviously, this paper represents our own views and not necessarily those of the GRC. I will start this presentation, but by introducing a bit motivation on the topic, on the climate risk and the implications for the financial system. Then I will move on to the methodological part. I will briefly present the data, the main results, and then we will close with the main findings of our study. So regarding the motivation, as most of you are aware of, since September, we have a new sustainable finance strategy for Europe. In particular, this is the continuity of the 2018 action plan of financial sustainable growth. So as the context is changing and evolving, there are needs to deal with 4 main challenges or pillars. So on the one side, we have the products, the tools that are necessary in order to continue the transition to a sustainable economy. On the other side, we have to deal with aspects like the small and medium enterprises, how they fit in this transition. Then we have a coordination of international authorities in order to do this transition all together. And our paper will be related with this third pillar, in which we study the resilience of the financial sector and the contribution of the financial sector to this transition to a low carbon economy. So within this pillar, we have several ideas that the new strategy look to deal with. So integrate sustainability risk in the risk management of financial institution, monitor potential systemic risk coming from ESG challenges, and develop a robust framework to measure the progress made by the European financial system. So regarding the point of the monitoring of the potential systemic risk, here we are asking ourselves how financial firms could behave in a market scenario which is coherent with the narrative given by the NGFS, so the network for the greening of the financial system. So if we are thinking of financial institutions, then we may ask ourselves how benchmark risk measures for the management of the firms, like value at risk, expected shortfall, may change under the different transition scenarios to a low carbon economy, or how the capital needs may change for the financial firms depending on the climate transition scenario. And also, we ask ourselves whether these previous questions would have different answers depending of the business model of the financial firm. So depending if the financial firm is a bank or is an insurance company. Within this pillar, another challenge is to develop a framework that could be feasible to measure the systemic risk coming from the climate transition risk. Could we answer the previous questions using public data, market data, and a methodology that can be easily replicable? So what we are going to do. So we have three main scenarios, which are inspired by the scenarios from the network of the greening of the financial system. So an orderly transition, a disorderly transition, and a hothouse world, which imply changes in the current expectation of the economic agents with respect to let's say the work stream and the step that we expect to follow for the completion of the transition to a low carbon economy. The changes in the expectation would imply asset price adjustments, both in green and brown firms, that at the end will impact in the financial system. So for instance, in a disorderly transition, we will expect that green firms will experience a flight to green from the investors or fund investors in brown firms to green firms. We would expect that brown firms will experience some difficulties to absorb stranded assets because the transition is performed faster than expected, or because brown firms then have to face a carbon tax burden. So we will expect that in a disorderly transition scenario that green firms will increase their quotes and brown firms will experience a decrease in their prices. On the other side, if we are modeling a hothouse world scenario, we will expect that green firms will be in a competitive disadvantage against carbon firms, and brown firms will face that the expected devaluation in the products are not materialized. For instance, because the transition is expected to be fulfilled by some step in the transition by 2030, and this step is moved to 2040. So the firms will face that they have assets that they expected to have a value of 0 because these are stranded assets, and by the expected date of the change of the transition, they are aware that these policy implications are not fully taking into account, so the asset that they have still have some value. So the expectation of the investors change, and we will find that the brown firms will experience an increase in the value of the assets, and green firms will suffer a correction from the market, because the transition is not performed as fast as it was expected. So basically, these two scenarios are the result of the disruption of the current business model from a change in the timing and the speed of the adjustments toward a low carbon economy. So summing up this motivation area section, what we are doing is to translate climate transition scenario into a coherent combination of green, neutral, and brown portfolios. So in an orderly transition, we will expect that the three type of portfolios will remain around the medium returns. In a disorderly transition scenario, we will expect that the green portfolio will experience an increase in its value, while the brown portfolio will experience a decrease in the value. Similarly, in a hothouse world scenario, the green portfolio will decrease in its value, and the brown portfolio will experience an acute increase in the market value. So once that we have translated these changes in the climate transition to changes in the market, we will compute some systemic risk measures that are already introduced by Adrian and Brunner Meyer, but we are going to adapt them to the climate transition scenarios that we are taking into account. So regarding the methodology, the first step will be to capture the joint distribution between each financial firm and the financial market. So in order to do that, we are using a flexible copula approach. We are taking into account tail dependence and positive and negative asymmetries. We are giving some dynamics that are provided by the model from Patton. And the copula methodology, the standard copula approach, could be quite rigid, because it implies that the same type of relationship is induced for all the assets for which we are computed the dependency. So we are using a bind copula extension, which is basically the use of the standard copulas in a hierarchical way, so as if they were bricks, in order to build a more complex structure that could be more realistic in order to reflect the actual relationship between the variables. So basically what we are doing is decomposing the joint density in a set of bivariate copulas that are linked one to the rest of them. In particular, we are using a bind structure, which would be the combination of two bind structures. On the one side, sorry, on the one side, we will have a bind structure for the market, and then we will have a bind structure for the financial firm, the relation of the financial firm with the market. Then, in order to take into account not the dependency, but the marginal behavior, we rely in a standard approach to take into account changes in the volatility, fat tails, and skewedness. So to present the methodology in the simplest way possible, we are showing here a 3D graph in which at each dimension we have either the returns of the financial firm, the returns from the brown portfolio or the returns from the green portfolio. So this 3D figure can be represented in a set of bivariate relationships, so scatter plots, and in the diagonal we have the representation of the histogram for the green, for the brown, and for the financial returns of the firm. So, for instance, for a disorderly transition climate scenario, we will expect an increase in the price of the green portfolio. So we will be in the right side of the distribution of the green returns, and we will expect a decrease in the price of the brown portfolio. So we will be in this left side of the distribution of the brown portfolio. So how can we translate this into dependency? Well, basically, what we are showing here is the copula formula that will allow us to represent this type of scenario. There are two parameters that we have to introduce, so alpha and beta. So alpha and beta are set equal to 0.2. So that means that the returns for the green portfolio are within the 20% of highest returns in the distribution, and the brown portfolio presents returns that are within the 20% lowest returns in its distribution. So once that we are setting these two scenarios, these two criteria together in order to build a scenario, what we will have is that the distribution of the financial returns will move from the blue bars to the orange bars. Similarly, for the orderly transition scenario, we will assume that returns for the three types of portfolios, so the green portfolio, the neutral portfolio, and the brown portfolio, are within the median. So as we are using copulas, and alpha we said is 0.2 and beta is 0.2, we are also setting delta between 0.2. That means that the returns for the three portfolios are between the 40 percentile and the 60 percentile. So we are taking into account the 20% central returns of each distribution in order to build this scenario. Obviously, when we are setting this scenario, the distribution of the financial returns for the financial firm will change accordingly. Finally, in the hothouse wall scenario, we will find the opposite scenario to the disorderly transition scenario. So we will have that the green portfolio, the returns for the green portfolio are within the 20% lowest returns in the distribution, and the returns from the brown portfolio are within the highest 20% returns in the distribution. And we will see that the distribution at the end is moving from the unconditional distribution to this conditional distribution that is coherent with the scenarios provided by the greening for the network for the greening of the financial system. The formula in terms of copulas will be this one. As we are setting the neutral portfolio, that is what means the U underscore N. In order to get the relationship between the green portfolio and the brown portfolio, we have to integrate over all the values of the neutral portfolio. because it's the first link in the tree of the network that provides the structure given by the buying copula. So at the end, what we have is a movement, a change in the distribution from the blue bars to the orange bars. Now that we arrived to this point, we can compute the mean return provided that we are in this new scenario that is provided by these orange bars. This at the end can be represented also in terms of copulas. We can provide a value at risk under a climate transition stress scenario that is provided by that return of the distribution of the financial firm returns that's conditional to a particular scenario have a probability gamma. Here the probability that we are setting to 0.10. So it's the value, the conditional value at risk conditional to a climate scenario measure with a confidence level of 10%. And finally, we are also computing the climate transition expected shortfall. That will be the mean return for the financial firm, provided that the transition scenario is materialized and the returns for the financial firm are below the threshold provided by the climate transition value at risk. Now, concerning the data, we are using more than 400 observations from 2013 up to 2020. This data is weekly, and we are getting this data from Bloomberg and Sustainalytics. From Bloomberg, we are taking the codes of the firms. For Sustainalytics, we are getting the carbon risk score for a set of more than 900 European listed firms. We are using the carbon risk score because it's the main measure employed by Morningstar to measure the transition risk in fund portfolios. Provided the score for each of these firms, we divide the group of firms in 3 groups. So the lowest quintile represent the green portfolio. The highest quintile represent the brown portfolio, and the rest of the firms are integrated in the neutral portfolio. Now that we have built these 3 portfolios, provided this information, we analyze the behavior of almost 200 European financial firms, in which more or less 1/4 of the sample represents a particular subsector, so banks, insurance, diversified financials, and real estate. And then we are analyzing also this information for the financial system at a country level, for which we have most of the European Monetary Union, but also countries which are not within the European Monetary Union, but they are quite important in terms of the financial system that they have and the possible interconnection with the European financial system. Regarding the results, we are going to split the results in 3 sections, mainly. First, I will present the results by sector. Then I will present the results by country. And then I will present the results in terms of the implications for capital needs. And finally, before the conclusions, I will also present some views of the output that we have obtained for a forward-looking exercise for the next 5 years. So regarding the risk measures by sector, we have seen a quite different behavior between sectors. While, for instance, real estate and financial services present profits in a disorderly transition, represented by the blue line, and the insurance company is not, let's say, affected because the disorderly transition scenario provides a mean return quite similar to the orderly transition. The banking sector presents a negative return in the disorderly transition. Regarding the hothouse world scenario, that is represented by the red line, is quite volatile for all the sectors. If we look at the climate transition value at risk, this is the results for the in-sample exercises. We can see that for the banking sector, we have lower returns, median returns for the banking sector, while the lowest returns for the median cross-section result for the rest of the subsectors is provided by the hothouse world scenario. We are presenting here some areas that represent the interquantile rank for each subsector in cross-section, because the value at risk is not an aggregable measure. For the expected shortfall under a climate transition scenario, the results are quite similar. Also, it's quite interesting that for all the subsectors, excluding the banking sector, the hothouse world scenario presents a higher dispersion, a higher heterogeneity between the firms that are in that subsector. While under the disorderly transition or the orderly transition, the let's say the interquantile rank is quite tight. Now, if we see the result for the climate transition expected returns by country, we can get several ideas here. On the one side, in a disorderly transition, the countries that are most affected are Spain, Portugal, Ireland, Italy, and Poland, which are all of them countries from the periphery of Europe. While in a hothouse world scenario, the countries which are the most affected are countries like Finland, like Norway, like UK, like France. Also, it's quite interesting that the gains that the countries from the north of Europe are obtaining in the disorderly transition is limited to 1%, while the gains that the countries from the south of Europe are obtaining from a hothouse world scenario are higher than 6%. Now we are presenting here the implications of these climate transition risk measures for the capital needs of the companies. We are following the methodology to build the S-risk from Engel, in which they are defining the capital shortfall as the difference between the capital reserves that the financial institution has to hold and the actual available capital. So a negative capital shortfall means positive capital buffer. And what we are trying to compute is the capital shortfall under a climate transition scenario. So at the end, we will have 3 different needs of capital depending on the specific transition scenario in which we are computing these capital needs. Also, it's quite interesting that in order to build the climate transition risk, we are only taking into account in order to aggregate this data for the financial system, only the positive values. That means that we are not allowing netting between the firms. So the losses or the needs of capital from one firm cannot be covered by the gains of another firm. The excess of available capital of the rest of the firms. This is important to be mentioned, because when we are not taking into account that we are taking the maximum between 0 and a positive value, or the 0 and a negative value, in that case we will have 0, we will get that we have a negative climate transition risk. That means that the financial system can manage all the capital needs from the firms if we allow this netting. So the highest capital needs are obtained in the disorderly transition scenario. In particular, we can see that we are obtaining capital needs of around 140 billions of euros. That it could seems too much, but if we take into account other papers, like for instance the paper of Engel from 2014, Systemic Risk in Europe, this amount is only 1/3 of what they found only for systemic risk. So the potential capital needs of the financial sector is quite manageable if we take into account that the potential capital needs of the markets due to the interconnectedness in the financial sector will be 3 times this amount. So we can see that the losses are mainly focused in, let's say, a few companies from Spain, Italy, Germany. For the orderly transition scenario, the losses are quite small and not really important. And from the hothouse world scenario, we obtain losses mainly in banks, because here we are focusing our attention only in the banking subsector, which is the one that present highest capital needs from Northern Europe or France. We obtain that most of the capital needs under this scenario are gathered in 4 firms, but the losses are, however, lower than the losses that we obtain under the disorderly transition scenario. So finally, we are computing also by doing a simulation exercise the possible paths of the the risk measure of the climate transition expected returns for the different subsectors. We are using the climate transition expected returns because it's an aggregable measure, and we are presented by the line in the middle, the median value across all the simulated paths, and the dot lines in the bottom and on the top represent the 90% confidence interval. This exercise only confirms what we have already presented along the study, in which real estate and financial service are positively exposed to a disorderly transition, but negatively to a hothouse wall scenario. The insurance companies are negatively exposed to a hothouse wall scenario, but they are quite neutral to a disorderly transition scenario. And the banking sector presents losses within the hothouse wall scenario, and some gains, but these are lower than the losses in the disorderly transition scenario. So to conclude, because I'm reaching the 40 minutes, what we are trying to do in this article, so we are describing an empirical framework to quantify the systemic impact of the climate transition risk on financial firms. We are translating climate scenarios into systemic risk measures well known by the industry by representing the expected change in the stock market depending on the degree of exposure to climate transition risk of 3 portfolios. We are also studying the implications for the capital needs in the European financial system. We are computing some forward-looking climate transition measures for the next 5 years. And the most important, we are defining different scenarios using public data and employing an easily replicable methodology. This is quite an achievement with respect to other methodologies dealing with these topics, either because, for instance, the climate value at risk of deals is not straightforward to replicate, either because the Junt et al. 2021 in a technical report from the Federal Reserve, they do not take into account possible different scenarios, or because we don't have, or we don't need actually information about the loans and the portfolio of the financial firms, which is what Battistone et al. Are using in order to build a network structure to measure the impact of transition risk. What we have found, we have found that the climate transition measures reflect changes in the market movements that we have seen in sample, that banks are negatively exposed to disorderly transition, while the rest of the sectors are mainly exposed to the hothouse wall scenario. There is a large heterogeneity in the cross-section performance of the risk measures, especially for the non-banking system, and especially within the hothouse wall scenario. The south of Europe is the sub-region of Europe that is getting most of the financial losses in a disorderly transition scenario, while UK, France, and the north of Europe get the largest financial losses in the hothouse wall scenario. And we are also seeing that capital needs are led by different firms depending on the scenario. These capital needs are focused in the banking sector mainly, and these capital needs are quite manageable by the financial system. And in the next 5 years, we have seen in the simulation exercise that banks may be at a significant disadvantage in a disorderly transition, while financial service and real estate are likely to experience significant systemic risk from a hothouse world scenario. Thank you very much.
Thank you very much, Javier, for your effective presentation. I have, a curiosity, which is more on the methodological side, which is as follows. Okay, you used, let's say, a rather sophisticated way of modeling the joint distribution. Okay, the copula functions with, you know, this advance in the direction of the Vine copula. But I would like to know if it is possible also to model correlations in some sense of this dependence using, let's say, more traditional ways. I'm talking about, you know, the old DCC staff models, okay, which in some sense could be used also to compare your results. Have you thought about that? Do you think that it is not feasible to go in that direction? What is your opinion on that? I cannot hear you.
Sorry. The main the main issue that I find in replicating this result with a GARTS DCC under Gaussian assumption or student T assumption is that we are leaving out important features for the tail dependence. So, for instance, just to highlight that the relationship between in the market between the green and the brown and the neutral portfolio is provided by a BB1 copula that presents asymmetric tail dependence in both tails. And I think that this is very important to take these features into account when we are modeling the financial markets, because we have herb behavior and we have some stylish facts that shown that in distress periods we will have a much higher dependence. And as we are building these scenarios in, let's say, trying to capture these black swan events that occur 1 over 1,000 times, it is important to model properly the tail of the distribution. So the main issue about the simplification of the methodology is that you may capture the average dependence between the variable, but you may be far away from the actual response of the financial firms when these tail events materialize.
Okay, thanks a lot. And another curiosity I have is the following. Well, transition is very different depending on the countries you are considering. You have focus on Europe, which is obviously a natural choice. Would it be possible to compare, okay, what you found, the result with the transition you can experience in other countries? I mean, I'm talking about, you know, if data are available, well, US as a benchmark, for instance, China, I mean, other countries which can experience different patterns of energy transition. What do you think about that?
Yeah, the methodology, as we are simply relying in market data, can be easily replicated for the US or from Japan or for China. But for instance, the carbon risk score is built by Sustainalytics based in the reports provided by the firm. Here there is, let's say, a kind of model risk that you cannot take into account. So if the information that the firm is providing to the data provider is not reliable, if there is some time of greenwashing, then this greenwashing will, let's say, contaminate the carbon risk exposure, the carbon risk score, and it will imply that the measure that we are computing will reflect not the actual carbon exposure or exposure to climate transition risk, but we will introduce this type of model risk. So summing up, for developed countries like US, Japan, and so on, I think that this could be easily replicable. For some countries like China, that we may not have so many data regarding the exposure of the firms, or not so data in which we can trust, then this is a limitation, because we are basically relying in two things: market data and an indicator for the market, for the asset in the market of climate transition risk exposure.
Okay, thank you very much for your answers. Well, I think we can conclude here. Let me conclude with a brief comment. Well, this topic, which is very broad about the financial implications of climate risk, is a topic which represents a topic, one of the research line at the Fondazione Enrico Mattei, which we are fostering during this period, and we are collaborating on these topics with universities and international institutions. So one example is the European Investment Bank. So maybe, well, after your presentation, there will be the possibility of collaborating also with JRC. Okay, since I've seen you are very committed on this interesting research topic. Okay, so thanks a lot, Javier, for joining us, and thank you for the participant to this conference, to this webinar, to have stayed with us until now. Okay, bye bye. So thank you very much. Thank you.
Thank you very much.